Hey, hi traders. This is Parthiban, and today I want to share with you guys some analysis that I've done over the stocks. Now, these stocks I've made okay, let's click this. So I made an investment stimulation 5 years ago. Anything that gives me a 300% return. So I'm analyzing on that. Now, the stock that I'm going to look today is EVRI, which I've done the analysis. If you see over here, 2016, if you have bought this, okay, let me change the color. Yeah, 2016, if you have bought this at $2.96, this is the cost that you bought, and up to now it's about 341%, which is about total gain about almost 1500 USD. Now, a lot of people are beginners, they look for perfect companies. As Warren Buffett have used a lot of strategy to analyze a financial statement, because the financial statement is very important, because that's a real business reflection. We're not speculating here, we are actually investing. So investing, you need to know the bank statement, how's the company is progressing. All that is very, very important. Now, today I'm going to share with you what I have picked up, and I feel very useful to look at the things. Now, when looking at this chart, there's something called income statement, balance sheet, and cash flow statement. Now, before I jump into the stocks, I went and look and analyze since 2010 to 15 before we invest. What the company is now is doing good because the price have gone up, and data is almost different. But before we invest, how the statement looks like. Now, there are few things that Warren Buffett look for, and I'm going to share with you guys for free today. And I want you guys to understand, because with this knowledge, you actually can make a lot of terrible mistake by putting your money in stocks that's cheap, which may not rise in future. This can give you a very handy to predict the market. Now, first criteria which I look for is this revenue. See, we see for past 5 years, revenue was just ranging, and in 2015 it started rising. Now, these are the first criteria, first sign that company is doing well. So the revenue has to be rise. Now, how you're going to check is how the revenue is rising, how this company have acquired the revenue. How come for past 5 years the revenue was not rising and now is rising? If we look at this under the balance sheet, the goodwill also rise massively. And how the goodwill rise? Why the goodwill is reflecting, if the company is purchasing some many other companies, and the goodwill will be reflected here. So this company, if you see, okay, let me show you the bigger picture. Today I want to share with you guys the correlation, which is a lot of people missing out this, and people don't pay attention. Now you see the revenue rise, and when the revenue rise, there's another data rise, so the goodwill also rose. And if you see another cash acquisition, and they have issued bigger share. So what this company have done, the management of the company have done in 2014, this is 14 guys, look at this 14, they issued a share, and with that cash they actually start buying a lot of companies which has business deals, which has a better upside, which has a better assets in 2014. So with this action, they reflected a good revenue in 2015. So literally, they acquired more business through by issuing shares, and then they increase their revenue. So this is a good sign that companies start to progress. Another thing that Warren Buffett looks for is the gross profit has to be above 40%. But look at this. They had it very stable around 23, and then in 2015 they rise it to 38%. Now that's a very close to a highly competitive company which they have. So it is a good sign the company is making profit. And the SGA is selling general and admin. So this is overhead of the company, which is a 52%, which is very high, but they have brought it to 36%. Average 30% is very good. So that's something good sign. Now, since the revenue of increase, look at this. The interest expense, they actually took a massive amount of loan, and this is supposed to be less than 15% if they are very good company, but it's increased because why? Because they got orders, new orders. And if you see, because this one increased and there's a massive amount of expansion, depreciation was stated here, 127 million, and this is being reflected in the account receivables, which the money that they're supposed to receive is increasing. So that means the more money is outside, need to be collected, which is not yet. And this is another sign which I see the company is making progress. And look at this, look at the negative correlation. When a company have a negative, massive amount of interest, it reflects heavy loss in 2015. Now, a lot of novice, they see this kind of news or negative and it's not making progress. Look at this. The company reflected in 2016 negative loss, and the price is just dropping. A lot of people are offloading the stocks at this level. This is the best price to collect. Why? Not because it's dropping, but not simply all the stocks that drop as a value. Now, why I say we should collect, because they issued a share not to buy assets, because the asset to liability ratio is 1:1, almost 1:1. That means they never buy issue share to buy assets, which a lot of company does. See, the current ratio is the ratio between the assets and the liability. It's almost around 1. That means 1 liability to 1 assets kind of correlation. And look at their retained earning over here. Now, it might be heavy for you guys. That's the reason I'm sharing this, because that's 20 step by step, which knowing this, you actually can predict how the market going to be, but it's not clean chart. That's the mistake a lot of people does. See, they have cash in company, but in 2015 they use the cash for expansion, for predict the expand the company. So another things that very important is you should not have a preference shares. It's empty, which is good. Currently, like AirAsia having it's going to issue a preference share, which is bad for the company, because that's the most expensive borrowing a company can have. So there's a few things like this which I look for. Now let's come to the summary. Now, overall, if I see the company has a very stable revenue, start to rise in 2016, which is good sign. But how the revenue is rising through acquiring many businesses, and this acquiring many businesses cause them a lot of interest, which is a rate alert. Yet, and there's depreciation, massive depreciation, but their net receivable is also increasing, account receivable also increasing. The company is showing negative balance, but look at this, the company is trying to expand by issuing shares, and the money is fully invested, acquiring companies, and the revenue is increasing. Now, this is a good bet to bet on, because the company is not using the shareholders' money to buy assets, but they investing in the business. And this company have brought the SGA cost of the operating cost almost to 36%, and the gross profit margin to 38%. So literally, they are in a very good competitive, highly competitive advantage companies criteria, as Warren Buffett have almost stated 20 tips how to analyze. I've shared a couple of relevant to this. Once you know the entire 20 analysis, literally you can understand what is the company is doing. So with confidence you can invest. Now I'm actually going to share 100 stocks analysis, which is different industries. Those who interested, you can always WhatsApp me at 018-222-4013. It's actually 2 days financial statement masterclass, in-depth financial analysis, and we'll have a Telegram group, and every week we'll analyze 1 to 2 stocks in depth like this, which will give you confidence and can make you a profitable trader. Okay, thank you.